You look at your W-2 and it says you earned $120,000 last year. You've got your pay stubs, you've got your bank deposits, and you feel confident. Then your loan officer calls and says, the underwriter calculated your qualifying income for a mortgage approval at $85,000. Wait, what? Where did $35,000 in income go? After 36 years in mortgage banking, I can tell you this. What you earn and what lenders use to qualify you on are often two very different numbers. And it's not random. It's the mortgage underwriting process. Today, I'm going to show you exactly how lenders calculate income so you don't get blindsided. Hi, I'm Sean Biggins, realtor and former mortgage banker. If you've ever searched YouTube for things like how much house can I afford, mortgage income requirements, why did underwriting lower my income, or self-employed mortgage problems, well, you're in the right place. Because the biggest misunderstanding in real estate isn't interest rates, it's how qualifying income for a mortgage is actually calculated. By the end of this video, you'll understand how base pay is treated, why overtime and commissions get haircuts, how self-employed mortgage income is calculated, what lender overlays are, and how to protect your debt-to-income ratio before you apply. First, let's be clear on something. This isn't the bank being difficult. It's federal law. Under the Ability-to-Repay rule issued by the Consumer Financial Protection Bureau under the Dodd-Frank Act, lenders must make a reasonable, good faith determination that you can actually repay the loan. That means income must be verified, documented, stable, and likely to continue. The likely continue part is where most confusion happens. If you made $200,000 last year but you're unemployed today, your qualifying income is zero. Underwriting isn't about what you earned once. It's about what is reasonably expected to continue. And that's the foundation of mortgage underwriting. So before we talk math, you need to understand something called lender overlays. Agency guidelines from Fannie Mae, Freddie Mac, FHA, and VA set the baseline rules, but lenders can add stricter internal requirements. For example, FHA guidelines allow borrowers with credit scores of 580 with 3.5% down, assuming all of the requirements are met. But some lenders require a 620 or 640 score, and that higher score isn't an FHA rule, it's a lender overlay, and those can affect credit score requirements, maximum debt-to-income ratios, employment gap tolerance, and documentation standards. So if one lender says no, it doesn't mean automatically you don't qualify under a particular program. It may mean that lender has stricter internal standards, so always ask. Now let's get into the real question. How do lenders calculate income? Underwriters divide income into two buckets. Bucket one is your base pay. If you made $80,000 in salary, well, 80,000 divided by 12 is $6,666 per month. That's straightforward. And then bucket two is variable income, and this includes things like overtime, commission, and bonuses. And this is where the math changes. Most conventional mortgage programs prefer a 2-year history of variable income. In some cases, 12 months may be acceptable with strong documentation and compensating factors. But trend matters. If your overtime is stable or increasing, then it may be average. If your income is declining, lenders may use the lower current level or request an explanation, because underwriting focuses on stability. This directly affects your debt-to-income ratio, which determines how much house you can qualify for. Now let's talk about the group that experiences the biggest surprise, self-employed borrowers. If you're applying for a self-employed mortgage, lenders do not qualify you based on your gross revenue. They start with what you reported to the IRS, and usually that means your net income after business expenses. If your business generated $200,000 in revenue, but your tax return shows $40,000 net income, underwriting begins at $40,000, not $200,000. That's often where deals collapse. Now here's where it gets nuanced. Most programs generally expect a 2-year history of self-employed income. There are exceptions in certain situations, especially if you previously worked in the same field, but underwriting will analyze income stability, year-over-year trends, likelihood of continuance, and if income is declining, lenders may use lower revenue, additional documentation, or determine instability. Certain non-cash expenses may be added back, for example, depreciation and depletion. If your tax return shows net income of $40,000 and depreciation of $20,000, a lender may analyze adjusted income closer to $60,000, depending on program rules and documentation. But real operating expenses like rent, payroll, and supplies cannot be added back. If the money left the business, it's not qualifying income. And once business structures become more complex, like partnerships, corporations, multiple entities, income analysis requires full lender review. That's not something you want to estimate on your own. Employment gaps matter. FHA considers a 6-month gap or more an extended absence. Borrowers typically must demonstrate a return to stable employment, often requiring about 6 months back on the job, depending on circumstances. It's not an automatic denial, but it requires documentation. And here's a big one. Switching from W-2 to 1099 income right before applying can change how your income is treated. Even if you're doing the same job, self-employment income is typically evaluated over a longer documented period, and 1099 is considered self-employed. Changing how you're paid can affect qualification, so plan ahead. Now let's end with something positive. Non-taxable income, like Social Security disability, VA benefits, or child support, can often be grossed up, and that means lenders can adjust it to its tax equivalent value. Depending on loan program and documentation, this adjustment may range from roughly 15 to 25%. So $1,000 of verified non-taxable income might be treated as $1,150 to $1,250 for debt-to-income calculations. That can improve your qualifying position, and the exact calculation depends on program guidelines and lender policy. Here's the bottom line. If you want to avoid income haircuts during underwriting, separate base from variable income. Respect income trends. If self-employed, understand your tax returns drive the math. Ask about lender overlays and plan employment changes carefully. Please don't just take my word for it. All of this information reflects publicly available underwriting guidelines from Fannie Mae, Freddie Mac, FHA, and VA, and the CFPB. And I've placed the links to the official guidelines in the description below so you can verify everything yourself. If this helped you understand how lenders calculate income, please hit the like button. And if you want mortgage education from someone who has actually sat on the underwriting side of the desk, then subscribe. And I'll see you in the next video.